Hello, okay, here in this video. Currency war, that's right. That's what we got going on here. A little bit of currency war, a little bit of fluff and stuff. But there's something here I want to show you. This is going to be a two-parter, okay? So you'll have to follow this into the second part to hear the rest of the report that I want to show you. But I think this needs to be seen. And I think what this guy has to say has a lot of valid points with it, okay? It really does. And I think you need to be aware of this. But first off, I want you to remember this. I want you to remember when just before Bush left office and they did the bailout, everybody said no, of course, and they threatened martial law, and they got their bailout anyhow, didn't they? That's right. And where'd the bailout money go? Oh, that's right, it went overseas. Barack Obama came into office, and he gave you a stimulus plan. That's right, to put money into the economy, pump money into our economy and help our people. And the minute they gave you the stimulus plan and got the money printed, they took the money and shipped it right overseas, the same thing Mr. Bush did. That's right. That's because it's the bankers behind this. It's the bosses, Barack Obama's bosses. It was Mr. Bush's bosses, the same bosses Barack Obama has. See, Barack Obama don't run the United States. Barack Obama's a puppet. But most of you people won't believe that. But I want you to remember this. Where did the bailout money go and where did the stimulus money go? That's right. We all know where it went. It went overseas to not come to the American people. Now here they are getting ready to print up another, what, $600 billion? Saying they're going to pump it into the American economy. That's what they said during the bailout. That's what they said during the stimulus plan. But the money didn't go into the economy, did it? It went overseas. Well, so where do you think this money's going to go? Overseas. And what did Dwayne tell you? Dwayne told you that, what? They print money out of thin air, don't they? That's right. They just print money up out of thin air, nothing to back it. And of course, the more we print, the lower the dollar goes, and goes, and goes, until the dollar's no more. Anyhow, watch this news report, followed over to the second part. If you get into this, well, follow to the second part to see the rest of the news report, but watch this news report because I think it needs to be seen. Leave your comments and opinions. In the next video, you'll have a good one.
Hudson says finance has become a new form of warfare. Michael Hudson's distinguished research professor at University of Missouri, Kansas City. A former Wall Street economist. He's the author of many books, including Super Imperialism, the Economic Strategy of American Empire. Michael Hudson, welcome to Democracy Now! Why warfare?
Well, the object of warfare is to take over a country's land, raw materials, and assets, and grab them. And in the past, that used to be done militarily, by invading them. But today, you can do it financially, simply by creating credit, which is what the Federal Reserve has done. It's created $600 billion. It hasn't gone into the economy. The head of the Fed is known as Helicopter Ben because he talks about dropping money into the economy. But if you see helicopters, they're probably not your friends. Don't go out and wait for them to drop the money because the money's all going electronically into the banks. And the Fed has said, we want to give the banks so much money that they'll lend it out so you can begin to bid up prices on real estate again and pull the banks out of the real estate negative equity that it's in. So the purpose, according to the Fed, is to raise the price of real estate, to inflate asset prices. But that's not happening. The actual banks have lent less today than they did in 2007, so the money's going abroad. And it's going abroad not really to buy foreign companies so much, but to speculate in currency. Now, the Fed and the Congress 2 weeks ago said, we want China to raise its currency by 20%. This would create billions and billions of dollars of bonanza for Wall Street banks, and it would enable them to earn their way out of debt by essentially looting the China Central Bank, the Brazilian Central Bank, the Turkish Central Bank, and the other central banks, because you can now borrow money in America at 1%. So you'd put down, let's say, $1 billion of your own, $1 million of your own money, borrow $99 million of the bank's money. That's $100 million. You'd buy Chinese currency, RMB, for $100 million. You then say, raise your currency by 20%, which is what the Fed's asked them to do. That means that your $1 million now is turned into a $20 million gain, because $100 million is now worth $120 million. You've made a 200% profit. And for Wall Street, they deal in billions, not millions. And so this would enable the banks to make up their money by buying, essentially, foreign currency. They're doing the same in Australia. It's currency gamble.
Well, and meanwhile, the impact, because obviously this decision was made the day after the elections and at the Fed meeting. They saw what the political landscape was. There wasn't going to be any kind of stimulus coming from Congress, so they had to come up with a stimulus for Wall Street the day after the elections. But the impact on the American people of maintaining these historically low interest rates, as we were talking earlier before the show, if you have a little bit of money in a savings account right now, you're getting virtually no interest. So you're in essence being pressured to end up going into the stock market to be able to get any kind of return on your money. Those who still have savings. The same thing with the pension funds. What's happening to the American people as a result of this same kind of policy? Well,
if they have money to put in pension funds or savings, they're only able to get about 1% if they keep it safe. Otherwise, they're taking a risk in the stock market. But the key is not simply lowering interest rates. The idea is to flood the economy with credit so the banks will lend out more debt. And if the Fed's policy works, then housing prices are going to go back up so high that most consumers are going to have to pay 40% of their income for housing. They're going to have to pay more money for credit card debt. The purpose is to help the banks make money at the expense of the economy. It's not to help the economy at all. That's the really important thing. When they say the economy, they mean the Fed means its constituency, the banks, and the bank's product is debt, and that's what they're trying to prevent.
Is this inflationary?
It will inflate asset prices. It won't inflate consumer prices. It's actually deflationary for consumer prices, because if you're an American consumer and you spend 40% of your income for housing, 15% for debt service to the bank, 11% goes out in your FICA wage withholding, and about 10 to 15% in actual income taxes, that means that the average American has maybe 1/3 or 1/4 of their salary to actually spend on goods and services. So they have to spend so much on debt service and finance and insurance and real estate that there's no money to buy goods and services. So that's why so many stores are closing throughout the cities on the big shopping streets. It's deflationary for the economy, inflationary for the people who have wealth, inflationary for the banks, and it's the banks really at the expense of the economy.
But there is the reality now that the world has changed dramatically over the last 30 or 40 years, and you have now this sort of new independent force on the world scene, even in finance, which is the countries like China, Brazil, and other countries of the third world that are, in essence, standing up on some of these issues. What's happening in terms of their reaction?
The world is dividing into two currency blocks, and over the last few months, China has gone to Turkey, Malaysia, Thailand, and said, we want to avoid using the dollar altogether. They're treating it like a pariah currency. They're saying, well, let's make a currency swap. We'll give you our Chinese RMB, you'll give us your currency, the baht, and we'll do our trade in our own currency. We are isolating the dollar so that people are not going to use the dollar anymore. That's why the dollar is plunging on world foreign exchange markets. The whole world that America created after World War II of open markets is now closing off. And it's closing off really because the United States is trying to rescue the real estate market from all the junk mortgages, all the crooked loans, all of the financial fraud, instead of just letting the fraud go and throwing the guys in jail like other economists have suggested.
I want to play a comment from the Nobel Prize-winning economist Joseph Stiglitz. We interviewed him recently. He was talking about the Federal Reserve and its attempts to inject liquidity into the U.S. economy.
So the money isn't going into the American economy. The lending is actually below what it was in 2007. In a globalized economy, the money is looking for the best place to go. And where is it finding it? In the emerging markets. So the irony is that money that was intended to rekindle the American economy is causing havoc all over the world. Those elsewhere in the world say, what the United States is trying to do is the 21st century version of beggar-than-neighbor policies that were part of the Great Depression. You strengthen yourself by hurting the others. You can't do protectionism in the old version of raising tariffs, but what you can do is lower your exchange rate. And that's what low interest rates are trying to do, weaken the dollar. The flood of liquidity abroad is trying to push the exchange rates abroad, and they're saying we can't allow that.
That's economist